Hello there. Welcome to Commodities. Let's see how the energy complex is doing today. Here is the word from Trafigura, the giant commodities trading firm. According to Bloomberg, the oil market is headed for a, quote, super glut next year with new supplies meeting sluggish demand. Here's what Saad Rahim, the chief economist, said in a video that was published alongside Trafigura's annual results. Whether it's a glut or a super glut, it's kind of hard to get away from that. So that's a gloomy prognosis there. We're going to have more on oil, and we'll hear a case for a turnaround in oil, perhaps in the second half of 2026, though. Let's check out the metals right now. In particular, gold up again. Copper down a little bit, but Bloomberg NEF reckons that strength in copper prices is likely to last into 2026, partly because of loose global monetary policy, falling interest rates or already lowered interest rates, but also tightening supply fundamentals with a copper supply deficit set to begin in earnest next year. Mines are old, and there's been shutdowns caused by politicians. We know all about that in Panama. Community activism, and then also accidents. We've got Freeport-McMoRan hit with fatalities in Indonesia. But the basic problem is humanity has dug up just about all the easy copper. And interesting, it may be the metal of the future. It was possibly the first metal used by human beings thousands of years ago. Let's have a quick look at the agricultural commodities. Not great news here for the U.S. Farm Belt. The Argentinian leader, Javier Milei, is reducing tariffs on exports of soybeans, corn, and wheat. He has repeatedly promised to do away with those taxes. Meanwhile, the Trump administration has unveiled about $12 billion U.S. worth of aid for U.S. farmers hurt by low prices. However, growers are apparently warning it's not going to be enough. Farmers are a key base of support for Trump, and this could see billions of dollars in one-time payments to farmers who've been hit by his tariffs and low crop prices. However, one Missouri farmer, Marty Richardson, quoted by Bloomberg as saying, this is kind of a Band-Aid. We need more markets more than we need aid, because, of course, China has moved against U.S. farm exports. And a couple of commodity stories we're watching right now. Shares in TransAlta up about 5% today. Power generator signing a deal with Puget Sound Energy to switch its power plant in Washington from coal to natural gas. And Exxon shares rallying, that energy giant targeting $35 billion US in cash flow growth by 2030. They are boosting production in profitable basins such as Guyana and the Permian. And shares in BHP higher today, up around almost 2%. Company selling a $2 billion US stake in the power network that supplies its iron ore operations in Western Australia. Almost half of that stake will be sold over to BlackRock, and BHP then will pay a tariff over a 25-year period. Let's stick with metals here. Anglo-American and Teck Resources shareholders have all voted, or both groups have voted in favor of the two companies combining. And that clears a key step towards the creation of a $50 billion metal producer. Let's get more from Thomas Seal, Bloomberg's Vancouver bureau chief. Thanks very much. It feels like we haven't talked to you for ages, Thomas. So just remind us, both sets of investors backing the deal.
That's right. I was just over at the Teck headquarters here in Vancouver, where it was a rather undramatic meeting. Lots of big, important shareholders were there, but no one said anything. There was a smattering of applause, and it looked like it wasn't particularly close in the end. The proxy result was sort of close to the 90% range. We'll get the full numbers in the next hour or so, probably. But yes, so both sets of shareholders have approved the deal, which really puts the ball in government's court, most important probably being Canada's government. There have been stories from some outlets suggesting that Canada has pushed for a redomiciling. We reported a few weeks ago that that's not on the table, but Canada is pushing for stronger guarantees from the companies for executive jobs in Vancouver here. As well as supporting their critical minerals strategy, so stuff around stockpiling potentially of copper and the like.
And Anglo has apparently dug in its heels, has it, on this redomiciling to Canada?
Yes, I think they gave an interview to the Globe and Mail where they said that that was not something they would consider. I think it would be a very it doesn't look like that's something that's being discussed based on our reporting, though others have reported other things. But there does seem to be some push still from Canada to get it through this investment screening that they strengthened last year to sort of show extract the benefits that they believe are commensurate with the deal for Canada.
The Australian Financial Review noting today that big mining mergers in the past have been rocky. You're combining assets, you're combining management teams, and of course, any mine takes so much maintenance. So it's often a judgment call. Do we spend on this? Do we spend on that? I bet one set of engineers will come in and say, what were you doing at this mine? I bet they all disagree.
I think maybe some people could even hope for that, a fresh pair of eyes. Not that I'm a complete expert on the mines in question, but there is a large mine Teck owns, which I think is close to one of the mines that Anglo owns, and it's had some operational difficulties. Yeah. So there's some hope that they could maybe iron out some of the creases there, and also just I think 800 million in synergies by the end of the fourth year is what they're targeting in terms of just the cash benefits. Of
course, that's the giant Quebrada Blanca mine in Chile where Teck's had such problems. Yeah.
Yes, exactly.
I bet it's like that with mining engineers. You know, when you get construction guys in there, they look at work other fellas did and they'll say, who did this? Anyway, Thomas, we'd better leave it there. Thank you very much indeed.
Thanks a lot.
Thomas Seal, Bloomberg Vancouver Bureau Chief. President Trump threatening to put a big fat tariff on fertilizer from Canada. Now, Scotia says he means potash because there isn't significant amounts of phosphate and nitrogen that come from this country into the U.S. Scotia says investors who like Nutrien should buy the stock, buy it on any dip. After Trump made that threat. Actually, let's have a look at NTR today because we did see some weakness. Scotia, though, itself does have a sector perform rating on Nutrien. But if he were to jack up the tariffs on potash, it would be a massive U-turn because a few weeks ago, he eliminated tariffs on all core fertilizer imports. And he had already issued an order to cut tariffs on imports of potash specifically. So that, Scotia analyst Ben Isaacson said, any big new levy on potash would leave many scratching their heads. But the big point he makes, and we just saw that in the quote board, is maybe America could make a small dent with domestic production. There's a Michigan potash project, less than 1 million tons of capacity, and they could try fast-tracking that. But construction isn't expected to be completed until mid-28, and history suggests closer to 30 for commercial product. And that would only be a fraction of the 8 million tons or so of potash that Canada ships to America every year, not just from Nutrien. Mosaic sends a bit as well, and K&S, the German company, but Nutrien is the dominant player. And finally, Scotia says Trump knows very well that potash tariffs will only anger his core constituency of MAGA farmers. Coming up, oil prices continue to slide as investors wonder about a peace agreement between Ukraine and Russia. However, CIBC's Rebecca Babin says maybe a peace deal wouldn't even be that big a deal. We'll be right back. Prices for Russian crude shipments from Black Sea and Pacific ports have fallen to their lowest levels since the start of the war in Ukraine. Our guest says there are signs that crude may well continue to grind lower regardless of a peace deal. Let's get more from Rebecca Babin, senior energy trader at CIBC Private Wealth. Rebecca, thanks very much for joining us. Stupidly, before the break, I said, oh, it might not be a big deal, a peace deal in Ukraine. Of course, it would be a huge deal for humanity and the suffering there. But I think what I meant to say was some oil market participants think Russian crude's been getting out anyway, so it may not be seen as that significant a ceasefire.
Yes, Andy, and I think your point's well received. It's a huge deal in some regards, but for the crude market, it may be more of a headline risk, and we may see that knee-jerk reaction if we get a peace deal, because in reality, we really haven't seen Russian flows impacted over the course of this conflict. Now, as you mentioned, the Russian barrels are deeply discounted, so they're trading at a heavy discount. Shipping costs, it's driven higher shipping costs and insurance costs. But at the end of the day, when we look at supply and demand and balances, the barrels are out there. The last month is a little bit different because we have seen some self-sanctioning from India, in particular, as they look at the latest round of sanctions and have pulled back on some purchases, which is why we see a tremendous amount of Russian barrels on the water. So it's not that their production has gone down or their exports have gone down. We just have more barrels on the water. And that is applying some pressure to the commodity. But I think you're right in thinking deal or no deal, the market and traders see balances remaining the same. Maybe some short-term disruptions if we don't get a deal as there's sanctions threat. But in the event of a deal, sanctions aren't going to be unwound instantaneously. That is going to be something that's proven over time. So the market really sees this as kind of a lockjam between maybe seeing a little bit less friction in the market in terms of shipping costs on a deal. And then if we don't get a deal, maybe more rhetoric around sanctions. The thing that's really driving prices right now, though, is the supply and demand balance heading into 2026, which most market participants and everyone is well versed in are seeing really large builds in the first quarter of 2026 and how that is kind of impacting day over day trading as the market prepares for a really well supplied, oversupplied market in the first quarter.
You note that so-called paper barrels look oversupplied, and that, of course, is the barrels traded in the financial markets. Is it a slightly different story when you consider actual physical barrels out there?
Absolutely. So that is the big kind of battle that's being waged in crude right now. If we look at time spreads, which is a physical market indicator of demand and strength in the marketplace, we're in backwardation, which indicates that demand is strong. Spot demand is stronger than what we're looking out down the curve. So that would not tell us, if we just looked at time spreads, that we're looking at a massive build coming in the coming weeks. And the reason the physical market isn't translating the way the financial market is a lot of the builds that have come have been shipped into strategic petroleum reserves in China. So these barrels haven't showed up in traditional kind of commercial pricing centers like Cushing for WTI. And so it's kept time spreads tight. But if you're a financial player and you're looking just at the macro picture, you're saying this is a well oversupplied market. There are more barrels out there than we are consuming. Whether they show up in Cushing or in OECD inventories, we don't care. And so there's where you kind of had this market that's kind of doing battle with itself. I will say this, though, consensus and positioning really in the financial markets is very short in the paper markets. CTAs, macro investors, hedge funds are all leaning very short. So if these builds don't come in as big as we expect, you actually could see a market that rallies even in a building inventory environment.
Isn't that interesting? Yeah, that's the way. I mean, a lot of people, smart people are buying oil right now. I know some of it's hedging, et cetera, or people are actually going to use the oil. But bearish sentiment can be a good sign.
Well, I think when it gets overly bearish and it's a little bit too consensus, it can be because everyone's leaning too far to one side of the trade. And even if that trade comes to fruition, there's really only one thing left to do, which is cover your short eventually. So I think when we look, though, at first quarter of 26, there will be continued pressure. These builds I think are going to start to materialize. It's just how much downside do we see? I don't think we see this move into the low 50s of TI. Maybe we see mid 50s and kind of grind around there. But when we think about how the market rebalances itself, that's where we need to start answering questions. If we're going to have these builds, what happens? Is it OPEC? Does OPEC change course? Is it a supply adjustment from like high cost producers like US shale? Do we get to see increased demand? Or do we see China put more barrels in SPR, right? So we need to think about those balancing mechanisms and where we think that's most likely to come from. I think it's going to be a combination of supply and China SPR that softens the blow of those builds. And maybe we do start to find a base in the mid 50s in TI and maybe in the low 60s in Brent. And if we can work through these inventories, maybe we put ourselves in a position to rally in the second half.
Just very quickly, I'm sorry we're tight for time, Rebecca. Exxon coming out with a pretty optimistic forecast on cash flow. Just remind us, in the Permian, are American companies making plenty of money right now?
They are. At the current strip, they're still making money. Plenty of money is questionable. The important thing out of the Exxon release is that they're going to be able to be more efficient with the reduced capex or the same capex. They're expecting to grow production. This has been the trend for years. U.S. producers have gotten continually more efficient, and that's the one thing to watch when we look for a supply adjustment at lower prices. Have they just become more efficient so break evens are now lower? So I think that's a critical point and something to really watch closely in 2026.
Thank you very much, Rebecca. Really appreciate it. Rebecca Babin, a senior energy trader at CIBC Private Wealth. Up next, our guest will give us some picks for commodities in the new year. His ideas include platinum and palladium. We'll be right back. Our guest is a commodity watcher who says there are signs the world is inching towards a wartime economy when it comes to natural resources. Let's get more from Bart Mellick, Managing Director and Global Head of Commodities Strategy at TD Securities. Bart, great to see you. It does sound alarming. And what you mean is nations are furiously stockpiling commodities in many cases?
I think they are, particularly in the U.S. I'm not sure that is always a conscious effort. But as we look into next year, I think there are many players out there who believe that we could see even higher tariffs or more broad tariffs in the commodity space, and that is incentivizing all sorts of hoarding. I think today's price action on silver is testament to that. We've seen copper at record levels. We're seeing aluminum surge, and all that is happening at a time where the fundamentals aren't necessarily as supportive as the recent price action would support. And of course, there is the Federal Reserve that we're looking at, tomorrow to see another cut.
But that's interesting. China, we know, has been building up vast amounts of oil, maybe simply taking advantage of low prices. But and certainly President Trump determined to ensure that America has supplies of these vital metals, even if it takes years to create domestic production.
I'm glad you mentioned oil here, and that is a big case in point. You have agencies like the IEA, the International Energy Agency, and others who are predicting massive surpluses in the new year, certainly in the first and second quarters. Yet here we are, under $60, but nowhere near low 50s or high 40s. And part of the reason is that China has been stockpiling a lot in its strategic reserves. And, we think that going forward next year, we're going to see as much as 1 million barrels per day of increases in their inventories, which is going to mute a lot of that negative aspect, and we're seeing positioning really short. So oil could surprise to the upside. In fact, we think we're going to get a bit of upside in the latter part of next year.
That's interesting. So for oil, give us that thesis again. You do see a potential rebound in oil, Bart? Because for one thing, you note that the U.S. rig count has been dropping steadily.
They have been, and we haven't seen as a robust impact as normally, particularly in the shale regions, as rig counts have dropped. And they have dropped, I think, north of 50 rigs. That's substantial. My hypothesis is, and this is what I've talked about at our TD Cowen conference, energy conference, just a few weeks ago, that we will likely see sub 60 prices in the early part of the year, and that is going to incentivize a lot of companies who gave positive guidance on production to maybe pedal back. So we might see declines in shale production. We're going to see a peak in non-OECD, and for what it's worth, we believe that the International Energy Agency is probably a little bit too optimistic on the supply side and too negative on the demand side of the equation.
We're looking at spare capacity here, a metric of TD Energy supply risk factor. And obviously that risk factor plunged during COVID. There was plenty of oil. Nobody was driving. But the OPEC spare capacity has been dropping.
It has, and traditionally that means that any time that happens, something bad happens in the world, that risk premium is higher. And what are the bad things that could happen? At this stage, we don't think anything in the Middle East in terms of a conflict. I think that's probably off. But we're certainly having issues with Russia. We've seen the last time I counted, we had at least 3 tankers being damaged by Ukrainian drones. Insurance rates have skyrocketed for that shadow fleet, and we could probably see more of that happening as the negotiations heat up, and everybody's going to try to get advantage. So that is one aspect. We're already projecting 300,000 to 500,000 barrels less from Russia, but that could be materially more.
We haven't got much time, a bit more than a minute. Copper, you note that American data demand is going to be a huge part of their electricity consumption, even compared with global benchmarks. The green line there is America, and the black line is essentially just a bunch of small countries. So America is going to need vast amounts of data centers, and of course that means copper, doesn't it?
It very much means copper, but not where you would actually think in the data centers itself, but more in the transmission side of that generation equation, in the transportation of energy, the step down transformers rather, switchgear and others. That's very copper intensive. But the real story, an interesting story that I think has been neglected, is natural gas. Globally, we're going to see some 500 terawatts of new consumption in the next 5 years. Half of that is going to be natural gas, and we calculate that could be of upwards of 4 BCF per day of extra demand. And we're not quite sure where that supply might be coming from for natural gas. And look at natural gas now.
We're going to have to jump, Bart. Thank you very much. And we'll have to get to palladium next time. We're out of time on commodities. Sorry about that. We've got the close coming up next.